Welcome to the next module of the certification, where we will look in further depth at what financial considerations you should make before going into business. In this module, we will look at the different ways you can set up your business and the impact it could have moving forwards. In addition to this, we will look in depth at the financial accounts to help understand what they are telling us and how to react to different scenarios that occur. When setting up the business, it's important to know that there isn't simply a one-size-fits-all, as each of the different avenues will have their own pros and cons for each of your own individual situations. For this reason, it is essential to take professional advice from an accountant or a solicitor to be fully aware of the different implications that going into business via each entity can have for your business. Think of this point as a crossroads in your business journey, as whichever path you will take can lead you on a different journey towards financial security. A sole trader business is owned and controlled by one person, although they may employ additional staff to assist them in the running of their business. These businesses are considered to be one legal entity in line with the individual that runs them. Therefore, the owner will be personally liable for all business debt that is accumulated through trade. If working as a sole trader, an individual would be expected to register as self-employed with HMRC and will be required to submit annual self-assessments, but generally speaking, their accounting requirements are less onerous than that of a limited company. When looking at the advantages of a sole trader, it's important to know that they are easier to set up and that the individuals will keep full control over daily and strategic decision making throughout the life of their business. However, the disadvantages include that there would be automatic unlimited liability between an individual and their business. Therefore, if the business were to fail, an individual could be forced to sell their personal assets in order to repay any outstanding business debt. The next entity to look at would be a partnership. As the name suggests, a partnership is a business that's owned by two or more people. When setting up a partnership business, a contract is usually drawn up known as a deed of partnership, which will stipulate how the owners will divide the ownership of the business. This can also include sleeping partners who have invested funds into the business but don't actually handle any of the day-to-day operations. Similarly to sole traders, individuals within a partnership business are expected to register with HMRC as self-employed. When looking at a partnership business, the advantages include that more people can contribute towards the business and the strategic decision making, which allows shared expertise of individuals who have complementary skills in business. However, the disadvantages of a partnership business include that there would be unlimited liability attached to the individuals and their business. Therefore, if the business were to fail, the individuals could be forced to sell their personal assets to repay any outstanding debt. The partners will be liable for any total borrowing that is attached for the business, and it won't simply be split amongst them individually. There is also the potential for disputes amongst the partners, which can disrupt the business even to the point of failure, which can lead to additional costs when adding in mediation or arbitration to resolve any potential disputes that rise. The next entity we're going to look at is a limited company. A limited company is an organisation that you can set up to run your business. It's responsible in its own right for everything it does, and its finances are completely separate to your own personal finances. They can be set up online through formation companies or through an accountant. However, they must register with Companies House and file their financial accounts annually, which will be available on public records. Therefore, for this reason, if going into a limited company, you must employ an accountant to produce these financial accounts to the required standard on an annual basis. Advantages of a limited company include the potential tax benefits for the directors, as they would take their own income through dividends as opposed to drawings taken from sole trader or partnership businesses. As the company is considered a separate legal entity to the directors themselves are not automatically liable for any company debt which is generated. However, it's worth noting that most banks or financial organisations will insist on taking a personal guarantee for any borrowing that is given to the business. The disadvantages of a limited company include that the additional documentation required will necessitate in hiring accountants and taking professional advice, which can increase the costs within your business. It is also less private than with sole traders or partnership businesses, as all information, including financial performance and company structures, will be available online on public record. The final entity we're going to look at will be a limited liability partnership. This entity is a corporate body that is subject to company law for its taxation purposes, however treated as a partnership for drawings and individuals purposes. There must be at least 2 members within a limited liability partnership, and a comprehensive agreement governing the duties of each of its members is recommended to be drawn up upon its inception. They are commonly formed within professional organisations such as solicitors and accountants to clearly define each partner's liability within a practice. The advantages of this type of business include that one partner is not responsible or liable for another partner's misconduct or negligence. It also offers flexibility in terms of structure. Partners receive their own drawings of self-employed income, and therefore there could be potential taxation benefits. However, the disadvantages of a limited liability in partnership include that the complexity will require additional support from accountants and solicitors, and again, similarly to a limited company, there will be a lack of privacy as all financial details must be disclosed to public record on an annual basis. Therefore, in conclusion, it is highly recommended that you take advice from the appropriate professionals so that you make sure you make the correct choice for your business, as it will be individual to your own personal needs. Understanding the financial aspect of a business is just as important as understanding the operational side. The only way to be able to manage the financial aspect of a business is to measure it, which is why we use financial accounts. It's an important statistic to know that businesses go under most commonly when they run out of money, which shows the importance of keeping a close handle on the finances and being able to predict the cash flow when you go into business. To do this, businesses commonly produce 3 documents known as a profit and loss, a balance sheet, and a cash flow forecast. When first looking to purchase a franchise, the term franchise investment will be used to dictate the amount of money that will be required to buy into the franchise itself. A franchise investment can be made up of a variety of different items, including the franchise fee, any equipment costs, training costs, and working capital. These costs will vary for each franchisee, as each person or even territory will have different working capital requirements even within the same franchise brand. Franchisees can choose to fund their franchise acquisition using all of their own savings, or as a combination of savings and borrowing. Most banks will consider lending up to 70% of the total investment costs for established franchise brands. Therefore, a minimum of 30% of the total investment costs should be put forward using your own personal savings. In addition to this, it is advised that you keep some funds held in reserve following your purchase of the franchise as a contingency, just in case it takes longer than expected to grow your business to a position where you are able to take drawings from the business itself. This is also another reason why it isn't advisable to go into a franchise business with large amounts of personal borrowing commitments, which could add pressure to the business in its early stages whilst you're trying to build it up. As we stated at the beginning of this module, the main reason why businesses fail is because they run out of money. A term commonly used in business is cash is king, as cash will be what allows the business to continue trading. Financial accounts are an important tool to keep a close handle on this financial aspect of a business and can help draw comparisons on performance against different periods of time. There are numerous different entities that are interested in the financial accounts you produce in addition to yourselves. This includes HMRC, shareholders, banks, and franchisors. Each of these different organisations will have different reasons for having an interest in your finances, which is why it's very important for you to understand your own financial accounts before allowing other people to look at them. The profit and loss account shows a breakdown of the sales and costs of a designated period of time, usually compared on an annual basis. This will allow you to compare the sales performance of a business and identify any fluctuations to key areas, such as any increases in wages from previous years, which is why we calculate gross and net profit margins. The first line of the profit and loss report is usually referred to as the turnover or the sales, which, as the name suggests, is the total amount of money generated from sales within that period of time. Following this, you will see the second line referred to as the cost of sales. This line will include any costs that were directly incurred by the production of the goods sold. For example, a retail store's cost of sales will be the costs of their stock. However, a furniture manufacturer's cost of sales will include the cost of their materials and their manufacturing wages needed to produce their furniture. By taking the cost of sales away from the turnover, you will have your gross profit. This is an important area of the profit and loss, as this allows us to calculate your gross profit margin, which is a useful tool to compare any fluctuations between costs of goods over different periods of time. By being aware of this, you will be able to identify exactly where a business performance is being impacted if it is different from previous years. After the gross profit, the accounts will show a breakdown of the overheads, sometimes referred to as administrative expenses. These will include any other costs within a business to continue trading, such as rent, wages, or utilities. By taking these away from your gross profit, we will have what's referred to as your net profit, sometimes called your operating profit. This will show you the amount of profit or loss the business has generated over a period of time before taxation, drawings, and interest. This allows people to calculate the net profit margin, which again is useful to compare performance between years in order to keep an eye on any fluctuations in your overheads. It's important to realise that all margins are only useful in comparison to any other years within that business or businesses within the same sector. In isolation, the margins will reveal very little about a business, but when compared to other margins, it makes it easier to identify where a business is suffering and how to remedy any issues. The balance sheet shows the total value of a business's assets and liabilities at a certain point in time. If a business was to realise the value of its assets and pay all of its liabilities, it will show how much money is left over or in deficit. It can be used to show a snapshot of the business, usually at the end of a financial year, in order to compare its movement to the previous year. Here you will see an example of a typical balance sheet. You will see the first section is headed up as the fixed assets. These are items, as the name suggests, that are fixed and needed to run the business on an ongoing basis, which will include any property or equipment held within the business. In contrast to this, the next section highlights the current assets. These are items within the business that are cash or will shortly become cash, such as any debtors that owe the business for any goods sold. In terms of the liabilities, they would be split into current and long-term liabilities. Current liabilities would include any money owed in the short term, usually considered to be anything within 1 year. This would include bank overdrafts, creditors, and VAT. Long-term liabilities would be present if a business had taken out any borrowing over a term greater than 12 months, such as a mortgage or a bank loan. After the assets and liabilities, a balance sheet will include the capital and reserves. The capital is the money permanently invested into the business by its owners. The reserves will include all past profits generated by the business that haven't been drawn out by the owners. All of these then culminate to produce the shareholders' funds, sometimes referred to as the net worth. This figure, in its simplest form, is an indication of how much the business would be worth or owe out if it were to cash in all of its assets and repay all of its borrowing at that point in time. For you as a franchisee, it is very important to be aware of the strength of your balance sheet, as if you are looking to secure bank funding or generate funds from investors, they would both be keen to see how much the business is worth on paper before making any decisions to invest in your business. Here are some of the most commonly used ratios and key performance indicators used in conjunction with financial accounts and how they would be useful to you as a franchisee. If on your financial accounts you see that your gross profit margin is decreasing from previous years, it can mean that you may need to do one or more of the following: increase the volume of sales, increase the prices of any item sold, or reduce the cost of your sales, i.e. finding cheaper suppliers or negotiating better terms. If, however, you see a decrease in your net profit margin, then you will need to look closely at your overheads to see what can be reduced from them. EBITDA is a term commonly used by banks and franchisors. This is a useful comparison tool for the profitability of a business, as it will only measure the underlying profitability, not including variables such as depreciation and amortization. These variables would vary between businesses, therefore EBITDA is a useful comparison irregardless of a person's starting point. Although it may sound complicated, it is in fact a very simple calculation involving the net profit and adding back the items stated to give you an EBITDA figure for that year's profit and loss. The net worth is simply taken from the balance sheet by adding together the capital and reserves. This gives you the net worth of the business at that specific point in time. A cash flow forecast is a useful tool when planning the finances of a business. They are commonly used at the startup point of a business to map out the total incomings and outgoings within a bank account over a monthly basis. This is used to map out where the business could be expected to meet any pressure points. This is normally done in franchising by looking at the actual performance of historical franchisees or any pilot businesses to give an expectation of the levels of income that business expects to achieve month on month. It is very useful for franchisees to be able to plan ahead if they are expecting to meet financial pinch points at a point in time, as they will be able to look to gain additional bank funding to prevent any issues, or they can look to negotiate better terms with their debtors and creditors in order to meet their commitments. This is different to a profit and loss, as the cash flow forecast will include everything such as drawings and any initial investment made into a business to give an accurate prediction at how the bank account is expected to operate. As you can see from the example shown, the forecast will have individual entries on a month-by-month basis to track the total expenditure. It will begin with the opening balance, following any initial investment and expenditure to start up the business prior to trading. This is then built up with the addition of any sales achieved during that month, which are projected from the history of the franchisee's performances. Unlike a profit and loss, a cash flow forecast will only include sales once the funds are received. Therefore, if goods are sold but not paid for 60 days, the cash flow forecast will not include the sales until after the 60 days from point of sale. Following this, each of the individual expenses will be accounted for, including management service fees, director's drawings and VAT, to give a true reflection of all of the expenses that would go through the bank account during that month. This culminates to produce the net cash movement by taking all expenses away from the sales of that month. This figure is then added or taken away from the original starting balance to give you the closing balance, which would then move across into the next month's opening balance, as it would work as if going through a timeline. This section will look further at how you will realise your investment within the franchise and some key considerations you should have before beginning trading. It is important to understand your plans from the beginning and make considerations for how you anticipate on growing your business to the point of maturity and exit. By planning effectively, you will be able to maximise your return on investment. Firstly, it is important to know that no two franchisees will have the same time frame to realise a return on their investment. This is due to the vast number of variables, including the amount of borrowing taken to set up the business and the amount of personal capital injected into the business. Also, in addition to this, the time taken for a business to reach its break-even can vary from each franchisee to others. In addition to these, there are numerous other factors to consider, but the point is that it is very important for you as an individual to break down exactly what you have invested into the business from the outset in order to measure how long it will take to see a return on that investment. In addition to this, you will need to understand what you are looking to get from your business, whether it be to achieve financial stability or to grow to its peak in order to realise your investment upon the point of sale. Franchise businesses can be sold on following the successful development and growth of the business to the benefit of you, the selling franchisee. The business will have its own goodwill value, which you are able to include on your proposed sale price when you come to exit the business. This can be done by working closely with your accountant to make them aware when you'll be looking to sell your business in order for your financial accounts to fully display the strength that you have generated within your business. The break-even sales figure is when the business has achieved enough sales to meet its overheads without generating any profit. No business should begin operating without knowing this figure, as it is an important tool to measure when a business is viable or not. There is a simple tool used in business planning to calculate the point of break-even, which is completed by dividing the total overheads by the gross profit margin. This will give you the amount of sales needed to be generated in order to meet your overhead commitments. To give an example, I have shown the working out of the simple break-even for the business financials shown earlier on. They show that the business would have had to turn over at least £631,451 in order to meet its overheads. Now it's time to put these ratios you've learnt into practice. You will see an example set of financial accounts over the following pages. Your task is to analyse and calculate the 4 measures above for this set of financial accounts.